Okay. Can you guys see my screen?
Yes.
Okay. Let's go basic accounting. Very, very basic accounting. Tell me what's the basic accounting equation now. Who's going to tell me? Go for it. Don't be shy.
Assets is equal to liabilities plus owner's equity.
Assets equal to liability plus owner's equity. Excellent. That's the basic accounting equation. Now, in the very beginning, when the owner comes to the company, he's going to invest into the company and he's going to create equity. What he's going to invest? He's going to invest assets, correct? He might invest also liabilities. And for that, he's going to get equity. Again, during the period of time, this company is going to start generating some revenue and they're going to have expenses. Revenue minus expenses is going to give you net income, correct? Now the question is, to whom that net income belongs to?
Company.
Yeah.
To the company, that's correct. And the company, now the company owns that one. To those one will be the outside and those will be inside, correct? The outside liability is created for something that company done during the operation of the company, and they owe money to the people outside of the company. But the company also owes money to the people who are inside of the company, which in this case are the shareholders, correct?
Mm.
So every time when the company generates income, that income is going to be kept in the company as long as the shareholders doesn't want money. Now, obviously, the income is going to increase the shareholders' equity. So that's why the first statement that you said was the income statement. Second statement is the statement of owner's equity. And that statement of owner's equity, it's very simple. It starts with the beginning balance. Then we're going to add the net income, if there's a net income in the company. Let's see, let's add this income. And we're going to deduct the dividend. If the owners wants the dividend. Sorry, that would be less here, and that would be. And then we're going to have the ending balance of the statement of owner's equity. And the last statement that we're going to prepare is our balance sheet. Which balance sheet magically matching the accounting equation. Correct?
Mm-hmm.
So that ending balance of the owner's equity is going to flow directly right here on the equity section. The last thing that left is to find out how many assets we have and how many liabilities the company has. That's why usually you can see the equity, it will be equal to what? Based on the basic accounting equation, in that case, equity is always going to be equal to
Assets minus liability.
assets minus liability. Which one is higher, assets or liability?
Assets.
Assets. Now, question for you. It's a tricky question. Is it possible the liability to be more than the assets?
Yes,
Yes.
How?
would cause a loss to the company.
Loss in the company. So the only way, watch this. If we have to express this basic accounting equation as a percentages, correct? This one always going to be 100%, correct? Assets always going to be 100%. Now on the other side, to have the equation, what we have to have? 100%. But that 100% is going to come from liability plus equity. So now what you're telling me is liability is 110%. So what that means? Where should be equity now?
-10.
-10. Now the question is it possible that the equity to be -10?
No,
So back to my first question. Is it possible to liability to be more than the assets of the company?
No.
Mathematically speaking, it's impossible. In reality, that may happen. That means the owners lost everything, and now not only lost everything, they have to pay from their pockets to cover the difference. So yes, you're correct when you say the liability, it's possible the liability to be more than the assets. That means the owners is not only in bankruptcy, but they have to pay from their personal belongings to cover the difference. That may happen in the reality. It's not going to be preferable scenario, but it may happen. So where are we going from here? We're going from here to the point that what we're going to learn through this course. Let's go back to the counting equation. And through this course, what we're going to learn is, let's insert some cells here. This one, and I'm going to insert here another one. And we're going to start working with those cells. Fill the gaps so you can see actually what we're going to cover this course and what we covered so far. So far, I hope and I suspect that you already know that the assets are in assets you can find the current assets and long-term assets. Correct? Did you learn that? In the previous accounting course, did you talk about the current assets and the long-term assets?
Yes, sir.
Yes. So what's in the current assets then? Remember?
Cash.
What can I find? Sorry?
Cash,
Cash. What else?
Laptop,
Sorry?
laptop, phone,
accounts receivable,
Accounts receivables. I can find accounts receivable. What else?
inventory,
Inventory. Correct. And some prepaid expense.
prepaid expense,
Excellent. Long-term assets. What can I find there?
building,
machinery,
equipment, and
building,
items,
Okay.
vehicles.
How we gonna call all these sections to be easy for us? Property, plant, and equipment, right?
Yes.
And what else we can find here? We're gonna see from this course we can find here some investments.
Investment.
So here I can find cash. Let's put this thing. I can find cash. I can find accounts receivables. I can find inventory. That's accounts payable. Not yet accounts payable. That will be inventory. And we can find some prepaid expenses. Okay, liability. Now, this course is on the other side of the equation. That's why we're going to focus on this course, and we're going to see what's happening on the other side of the equation. What is liability? What type of liabilities we have, and
How
what
to
is
pay it.
equity? What's equity, and what type of equity we have. So the first chapter 13 and 14, we're going to talk about the liabilities. Equity. And we're going to see today from where the equity comes, and the next time we're going to transfer and see what increased the equity, what decreased the equity, and all those things. Then we're going to move to the liabilities, and we're going to find what kind of liability. That will be chapter 11 and chapter 15. Then we're going to talk about the investments. That will be chapter 16. And then we're going to focus on the last financial statement which you haven't seen and we haven't discussed here. Here we discuss the income statement, we discussed the statement of owner's equity, and we discussed the balance sheet, but we didn't discuss the cash flow. So in chapter 7, we're going to capture the cash flow. Chapter 18, we're going to do some financial statement analysis. And that will be our course. The only thing that I miss is chapter 12, which will deal with the partnership, which is different animal. But with the partnership, we're going to deal with the entire accounting equation. So let's go now with the today's chapter and see what we can get from there. How is it so far?
Good.
Good? Not too hard, not
Good,
too
sir.
easy, not too difficult.
Not too hard yet.
No, we're not going to keep it hard. Hard is not for accountants. We like things easy. Now let's go with the corporation. We're going to move now to the corporation level, and we're going to see what's happened with the corporations. First thing, we're going to establish what the corporation is and what the corporation is doing. Now, the form of business, you can form the business three ways. One is that's only corporation. One is the proprietorship, which you already know, and the first part of the accounting was based on the proprietorship idea. Then we have the partnership. In chapter 12, we're going to see what the partnership is. And then we have those corporations. There's advantages, disadvantages for all those type of business organizations, how you organize the business. Now, what will be the legal form of the business, that's a different story. So, that's exactly the legal part of the business. Right. The legal part. Legally, I can create proprietorship, or I can create partnership, or I can create corporation. What type of corporation we may have? We may have two types of corporations in North America. One is the public corporation, and the other one is the private corporation. What means public? Public means that the shares of the corporation are publicly traded on the open market. Which market will be that? Well, that will be stock market. Now, the shares of the company, we're going to call it stock. And that stocks, those are traded only and only on the stock market. And when we have movement from one stock to one person to another person, that's called stock exchange. Because those two people exchange something, and one giving the money, the other gets stocks. And then the other gets stocks and exchanging money. And keep going, keep going. Now, one thing that you should know is you cannot buy stocks on the farmers market. On the farmers market, we can buy groceries. That's why it's called farmers market. On the stock market, we cannot buy groceries. Why? Because it's not a grocery, it's not farm market. It's a stock market. That's how we should clearly differentiate those two. Interesting with this type of corporation, public corporations, which are publicly traded, they have to follow international financial reporting standards. Why they have to follow international financial reporting standards? Because person from everywhere in the world can invest in those companies. So, do I want people from everywhere in the world to have access to my shares so they can invest in my company? Yes, I do. Well, if that's the case, then they have to follow some standards. Which standards? International financial reporting standards. The other option that they have is I don't want my shares to be traded publicly. I want to keep my shares for myself and for my family, and that's it. Now, that's going to make me private company. I can still, now, don't get me wrong here, I can still sell my shares, but they're not available to the public. They're not traded to the stock market. Those are privately held, and there's no trade on the stock exchange. Now, since they're not traded on the stock exchange, they don't need to follow international financial standards, reporting standards. Only if they want to, they can have a choice to follow the international financial reporting standards. But in reality, they won't follow those. But they want something very simple. Why? Because my only user can be myself. If I don't have a loan from the banks, if I don't have any other people that I owe money, I don't need to follow standards. The accounting standard for the private enterprises is more than enough for me. I don't need to follow international financial reporting standards. I'm not planning to sell my shares, to trade my shares on the stock exchange. But if the private company wants to become public, now they have to start following international financial reporting standards at some point. Which are the characteristics of the corporation? Why anyone can want to open corporation, and what kind of benefits he's going to get once he opened the corporation? First, we're going to separate the owner from the corporation. So what that means is we're going to have corporation will be separate legal entity which has nothing to do with the shareholders. Then that's going to give the corporation ability to have a continuous life. Since the corporation is by itself, separate legal entity, what's going to happen with the shareholder physically is irrelevant. The point is who owns the share. Now, the original owner of the company, once he opened the company, later on, he doesn't have to be the shareholder forever. He can sell his shares, or he can transfer his shares, or he can donate his shares. But the company is going to still exist. There will be no mutual agency, so that means the owner cannot sign binding contracts. What that means is, watch this. Imagine today I'm buying one share from Apple. Am I shareholder of Apple?
Yes.
Can I go to the bank and say to the bank, I want to take $10,000 on behalf of Apple
No.
and put it on the Apple company? Can I do that? No.
No.
But hold on a second, I'm the shareholder. How come? Because the shareholders, it doesn't, whatever the shareholders doing, the owners cannot bind the company with whatever he's doing. Owner's business is his own business, has nothing to do with the corporation. Make sense? that also give you the limited ability to the shareholders. The shareholders are limited only first to the number of shares that they own and to the voting rights that they might have by owning that share. Obviously, we're going to have the separation from the ownership and the management. That's why the owners can drink his margarita on Hawaii, and the manager will be the one who's going to work in the company. Now, that corporation has to pay us corporate taxes, has to follow some government regulations based on the business they're running, and they might have some unique cost of running the corporation, which might include insurances for the directors, for the officers, for some other reasons which are specific only to the corporations. Which are the advantages? Now let's see what are the advantages for the corporation. First, corporation itself, if it's public, can raise more money than the proprietorship or the partnership. It has continual life. I can transfer it easily from one person to another person. Nobody can bind the company with whatever he's doing, so there's no mutual agency here. And the shareholders have a limited liability. So what that means is if the company going to bankrupt, the owner of the company or the shareholders, they can be perfectly wealthy and can still living their life. The only thing is, now I have to tell you this. I want you to know this. If in Canada, if the corporation owes payroll and owns to the government, so that means for the payroll and for the government liability, the owners are personally responsible. Only for those two. For anything else, it's fine. Now the disadvantages. The disadvantage is that the owner and management those are separated. Now in some corporation, especially the private corporation, you may see the owners acting as a manager. Then the owner can actually monitor and exercise some level of control over the operations inside the company. That give him more access to the day-to-day operation and how the company respond to different events in reality. But most of the time, the owner is separate from the manager. If I own one share of Apple, I cannot pick up the phone and say the CFO, hey, what are you doing? Why not investing in this part, but investing? Why are you spending more money on this or not on that? I cannot do anything. Earnings, earnings that you may get from the corporation, it might be to some extent double taxed. Later on in the tax courses, you're going to see how this is going to happen. Disadvantage is the corporation has to have some regulations, which can be very expensive. It might have some unique costs, which are only and only related to the fact that it's a corporation. And the other thing is the board of directors often require specific insurance. Now let's see what's the organization of the corporation. Organization is similar to how can I open corporation? First thing first. Do you know how to open business in Canada? Yes or no?
No.
No. It's very simple. First thing what you have to do is you have to file to BC authorities. There's a search for name. Choose the name of the company and you do the company as company name search. Once they confirm that the company, the corporation name that you choose for your corporation doesn't match any other company that has been created already in BC or in Canada, they can tell you you have 3 days to register your corporation. Then you can file the documents for registration of the corporation. Once they give you that, they're going to get the business number. Once you have the business number, you can get a lawyer to get your article of incorporation. And those article of incorporation will be subject to provincial federal government approval. Once the article authorization incorporation is issued, then you can start issuing shares. Usually, you're gonna, if you're the owner, you're gonna put 10 shares. Each share is worth $1, and you're gonna invest $10 in your corporation, and you have your corporation. Who's gonna have the control? Shareholders. Then the shareholders, you can elect board of directors. If you're a big corporation, you can elect board of directors. And board of directors, why do we need that board of directors? Because those are the smart people who's gonna set up the policy. They're gonna choose the chairperson who's gonna, run the board meetings. And the board of directors is gonna appoint the president. So basically, you're going to this structure. This is the corporate governance level, if you want to put it this way. So what we have here, we have a shareholders, which the shareholders electing the board of directors, led by chairperson. So if you see big limousine with some fancy guy going out of the limousine, most likely he's the chairperson for the board of directors in some corporation. Now the board of directors, when they set up the policy, they're going to choose the president. Or they can choose the chief executive officer, and he's going to start hire the rest of the people. And now you see the structure of the corporation. To some extent, in the very beginning, you have a centralized structure. At some point, become a decentralized structure. Now, what is share capital? Share capital certifies who's the investors or who are the owners. We're going to have on the article incorporation is going to say this. This company is authorized to issue over the life of the company, let's say 10 million shares or unlimited shares. Of those share certificates, which are issued to the owners, we don't have to issue all the, let's say the company is authorized, have authorization from the government to issue 1 million shares. Now the company don't have to issue 1 million shares. The company is going to only issue the shares that can sell to the public. If they think they can sell only 1,000 shares, they're going to issue only 1,000 shares. Why is that? Because the issuing of shares is related to the cost. Now, out of those 1,000 which are issued, how many are sold is a different story. So for that reason, the company may have 1 million authorized shares, 1,000 issued, and 500 outstanding. What that means is from the 1,000 shares that we issued, we sold only half. So the outstanding shares are actually the shares which are held by the shareholders. Make sense? Are not in the possession of the corporation, they're possessed by somebody else, which is the shareholders. Now the shareholders equity section is going to have two main sources. We're going to have contributed capital and we're going to have retained earnings. So if we have to go back to our Excel spreadsheet, Let's switch quickly to the Excel spreadsheet. If we have to go back to the whole Excel spreadsheet, open it. Spreadsheet. See, there it is. So what that means is under the equity section, we're going to have two sections. We're going to have contributed capital and we're going to have retained earnings. And now we're going to start building from where the contributed capital comes and from where the retained earnings comes. And we're going to see how we're going to start building this Excel spreadsheet, and we're going to come up with the different things. Let's go back to the slides. First thing first, contributed capital. Contributed capital comes directly from the shareholders. The common shares are only one type of the share capital. Let's now, in this case, let's assume that the corporation received $200,000 cash from the shareholders. And obviously, corporation have to give them something, so they give them common shares. Very basic journal entry. Corporation get the cash, debit cash. Nothing on the liability side. Assets, as you can see, going up. Liability is not changing the liability, and the common shares goes up. That means equity increase. So we end the perfect equation. Assets are $200,000, liability is zero. Common shares $200,000, and we, as you can see, we issue only 10,000 common shares. From here, what we can do is what's the book value of the shares, and the book value of the shares will be the amount of money that's sitting in the common shares divided by the number of common shares. Now, retained earnings. What's the retained earnings? As you probably saw in the previous course, retained earnings is the money that stays in the company. From where the retained earnings comes? Retained earnings comes from the obviously profitable corporations or operation. You have to have a profitable operation which is going to generate you income. If you decide to keep the income in the company, that means you retain the earnings. The shareholders may say, hey, I don't want to retain my earnings in the corporation. I need the money to buy my wife back from Hermes, for example. So what they're going to do, they're going to draw dividends. The dividend will be the one that's going to decrease the retained earnings. So let's go with the profitable operation. Have the net income, means revenue is more than expenses. That means that net income is going to increase the retained earnings. From where the retained earnings comes, when doing the closing entries at the end of the period, we're going to close the revenue accounts, we're going to close the expense accounts into the income summary account, as you remember. Is that how you learned it last semester?
No.
No?
No.
Oops.
No.
So you don't know anything about the income summary account?
Actually, no.
Oops. Okay, that's not good then. Then the follow-up question will be, who taught you the previous question? You can just type it, don't say it. So you have no idea about the income summary account, correct? So in that case, what we're going to do is income summary account is a special closing account which is created at the end of the adjusting entries at the end of the closing period. Why we need that income summary account? We need the income summary account because at the end of the period, the actual end of the period, like a fiscal year end, we want to reset certain type of accounts. In accounting, we have balance sheet accounts, accounts which belong to the balance. We have income statement accounts, which belong to the income statement, and we have shareholders accounts, which belong to the shareholders. In also, they belong to the equity section of the balance sheet. Now we're going to have accounts which ending with the balance, and we're going to have accounts which are going to end up with zero. The account which ending with balance, those are balance sheet accounts. The accounts that's going to end up with zero, we call it cumulative accounts. Why do we need the cumulative accounts? Because within the period of time, we want to accumulate some things inside to see what's the effect, and at the end of the period to close those accounts to zero. So when the next period starts, we can start accumulating again. Imagine if the revenue account wasn't cumulative account, means ending balance of the revenue doesn't end up with zero at the end of every period. Then what that means is very simple. Imagine the company the first year of operation, the company generating $200,000 revenue. So we keep that $200,000 for the next. So the next period, let's pretend we made this, and we put those $200,000 as a beginning balance. Next year, we generating new revenue. At the end of the period, we're seeing that revenue account have $600,000. Now, when I see the balance in the revenue account, do I know which of the revenue belongs to the first year and which of the revenue belongs to the second year? That will be very hard, right? That's why for the revenue and expenses, at the end of the period, we're going to bring those accounts to zero. We're going to close those accounts into the income summary account, and the income summary account, we're going to close it to retain earnings. If the revenue is more than the expenses, as you already know, the revenue is on the credit side always. Expenses are always on the debit side. That means when we put everything in the income summary account, the income summary account is going to end up with credit balance. When the income summary account end up with credit balance, that means the company generated income. If the income summary account end up with debit balance, that means the company generated loss. So obviously, if you have account with the credit balance and you want to bring it to zero, you have to debit that account. And that's what's happening here with this journal entry that we're doing December 31st. We're actually closing income summary account. Where we're going to close it? We're going to close it into retained earnings. Regardless what's happening in the income summary, is it going to be credit balance or debit balance? Means, again, credit balance means the company generating income. Debit balance means company generating loss. In both cases, we're going to close what income summary into the retained earnings. Remember, retained earnings is part of equity. Means, do you know the base from the basic accounting? Let's go back to the Excel spreadsheet. If we come to the basic accounting, which is the basic accounting equation here, I'm going to paste it here somewhere below. Or let me open new Excel, new worksheet. Obviously, later I'm going to give you access to this worksheet. Don't worry about it. So I want to delete something, but I want to delete this part. So obviously, we're going to have accounts under the assets, and we're going to have accounts under the liability and equity. On the T account, let's draw some T account here. On the T account usually looking like this, correct? That's your T account. And if it's a balance sheet account, that T account is going to have a beginning balance and it's going to have ending balance. If it's an asset account, actually, no. Let me get rid of this for a second, and I'm going to create something different. Let's delete this. I'm going to open one T account here. 1, 2, 3, 4. This. You're familiar with the T accounts, correct?
Yes.
Okay, that's good. So under all of those, under the assets, we're going to have the T account. That's going to start beginning balance, and we're going to have ending balance. Let's increase those one a little bit bigger. See that clearly. And in this here, then we're going to have on the other side, we're going to have T accounts as well, right? But what's the interesting here? For the liability and equity, our beginning balance and ending balance will be on the other side. What's on the other side? If this one is debit, on this side we have credit. So technically speaking, assets accounts always have a normal balance debit, and the liability and equity accounts have normal balance credit. Correct? Are you guys with me?
Yes.
Yes,
Yes, bro.
Professor.
Okay, what that means. So, what's going to happen if somebody asks you, what's the normal balance for the liability, and you forgot all this? The only thing that you have to remember is the basic accounting equation. And once you have the basic accounting equation right here, what you have to remember is if I draw the T account from the basic accounting equation, like this, everything on the right side, on the left side of the equation has debit balance, and everything on the right side of the equation has a credit balance. That means assets accounts always going to have normal balance debit. Liability and equity accounts always going to have normal balance credit. Again, from the accounting equation, waste the equation, draw the line down, make the T account, debit on the left, credit on the right. Whatever falls in that category of the credit, normal balance credit. Whatever falls on the debit, normal balance debit. For the asset, what that means for the asset is every time when we debit the asset account, we increasing the balance. Every time when we credit the asset account, we decreasing the balance. Make sense?
Mm-hmm.
Now, every time when we have the debit, let's put this one here, insert, and let's insert these shapes here. Boom. So every time when we have a debit, I'm going to increase this balance up. And every time when I have credit, I'm going to decrease this balance. Let's move this one here and flip to the other side. And that's how this works. Now, for the liability and equity, since the normal balance is credit, work opposite. Every time when I have a credit, that's going to increase my balance. And every time when I have debit, that's going to decrease my balance. So now, let's go back to our slides. So once we now that's the income summary again is cumulative account, and if the balance of the income summary is credit, that means revenue is more than expenses. We have to close the income summary to zero. Then we're going to increase the retained earnings, and that's for that reason we're going to credit the retained earnings. So the retained earnings is going to go up. Income summary is going to draw down. Those two balance each other, so there's no effect on the assets and liability because again at the end of the day this is adjustment entry, adjustment closing entry. That's how it's called at the end of the day. Now positive amount in the income summary account means credit balance in the income summary. Now what's going to happen if the revenue is less than the expenses? Then in that case the income summary account is going to end up with debit balance. Then we have to credit the income summary account and we have to debit the retained earnings. But since the retained earnings belongs to the equity, and we already saw that every time when we debit the equity account, that reduces the balance. That means in this case, we're gonna generate the deficit. Or shareholders' equity is gonna go down. Because the retained earnings part of the equity account, of the equity section of the balance sheet. Make sense?
Mhm.
Now, what else gonna reduce the retained earnings? Dividend. Profitable corporation, they may decide to distribute cash dividends to the shareholders. Now, the dividend is similar like on the proprietorship. The proprietor, the owner of the company, can just easily go and get some money from the bank account, and he can withdraw the money. In the corporation, that cannot happen because the shareholders they don't have access to the bank account of the company. Remember, separate mutual uh, agency. So for that reason, if the shareholders wants cash dividend, the corporation have to declare cash dividend and give them cash dividend. What's going to happen when the corporation declare dividend? That means eventually they have to give some cash, but that's going to reduce the retained earnings in the company. For that reason, in order company to declare dividend, they need to have a positive earnings first. And if they decide to give a cash, they need to have a cash in the bank account. Otherwise, there's no cash dividend. Now, what's the rights of the shareholders? Well, the shareholders, okay, I own one share. What's my rights? Well, I have the rights to sell the shares. I don't have to keep it for the rest of my life or not to do anything. I can sell it. I have those rights. Also, if I own common share, I have a right to vote. Also, I have a right to receive proportionate share of the dividends. What would be my proportion? Proportion to the number of the shares that I own of the corporation. Also, I may have the right to receive proportional share of assets when the business is closing. I also may have preemptive rights, which is the right to maintain proportional ownership in the corporation. What that means? Very simple. I'm going to explain. Let's pretend that I own 1% of the Apple, and the Apple wants to issue new shares. Currently, they have, let's say, 1 million shares outstanding. I owe 1% of those 1 million shares. Apple come up with the idea to issue another 1 million shares. But if they issue another million shares, the number of shares is going to become 2 million. And in that case, my percentage is going to go down from 1% to 0.5. Now, in order that not to happen, I may have a right that before Apple issued a new 2 million shares, they to come to me and say, hey, we're planning to issue 2 million shares. And since you have the rights to keep your proportion of the ownership of the company, we're going to offer you that number of shares, which is going to allow you, after the issuing of those extra $1 million, you still to have 1% ownership of our company. Make sense? So even they increase the number of shares, my percentage is still going to be the same. Let's see what's the record of the issuance of the shares and prorate the shareholders' equity section of the corporation on the balance sheet. Now, issuing the shares. Corporations, public corporations, they may sell the shares directly, or they can engage underwriters or company or the financial institutions who is going to sell the shares for them. In order to do that, they have to prepare those fancy prospectus. Same like buying a condo in Vancouver on the pre-sale. You're going there, they can build the future for you. They go give you all the good things. When you become a shareholder, your life's gonna change right away, and you're gonna start getting more money and everything and everything. Then the company is gonna go to the initial public offering, which is gonna give you prospectus the first time corporations. Now the interesting thing is that all the documents must be posted in the system for electronic document analysis and retrieval, with the abbreviation CEDAR. Now, if you go to the internet and call CEDAR, you're gonna find information for every public company in Canada. All the documents from the start of the company up to this point. Financial statements, midterm statements, audit reports, research and development statements, everything is there. Management reports, everything is in this system. That's a mandatory. Public companies have to publish those one in the system. So if you are interested in investing, go there, find the company, find the financial statements, decide should you invest or should you not. Common shares are the most basic form of the shares capital. Obviously, you may have more than one class common shares. Investor, obviously, who buys the shares, he's going to bear the risk. We may have non-par value shares, which don't have a value assigned to them, or we may have a stated value of shares, which may be assigned by the board of the directors when they initially issued. Example of issuing shares will be this company decide to issue 6,308,154 shares with the stated value of $17. Now, what they're going to get? Obviously, they're going to get cash. They have to pay somebody for all these expenses what they have for the issuing of shares, and they're going to issue common shares. But the value of the common shares will be number of issued shares times the stated value per share. Are they going to get exactly the same cash? As you can see in this case, no. They're going to get less cash because they have expenses to issue the shares. Now, let's go further. See the next one. Next one is, can I get some other assets than cash and to give the common shares? Yes, you can. In this case, as you can see, the company received equipment which worth $25,000 and building which worth $125,000, and company issue common shares with the value $150,000, which are in fact only 25,000 common shares for $150,000. How are we going to get the cost or the value of the equipment in the building? Well, we're going to use the current market value. That's going to happen when the shares are not actively traded and the value per shares cannot be determined. So we're using the fair value on the market value of the assets which are contributed to the company, and based on that we're gonna estimate and we're gonna assign the value to our shares. That's for the common shares. Now let's see preferred shares. We may have preferred shares. What's the interesting with the preferred shares? Preferred shares have a special rights. That's why they're preferred. Which rights? They might receive dividends before the common shares. They receive assets before the common shares if the corporation is liquidated. They may receive a fixed dividend. But what's the trade-off? Trade-off is generally they don't have voting rights. Obviously, there can be different type of classes, and often they have a futures which are attached to the shares. They might be cumulative, and they can be convertible. Now, the common shares, then in that case, will represent the residual ownership of the corporation after preferred shares are satisfied. So once we pay the liquidation, all the liabilities, the dividend, the liquidation, everything that belongs to the preferred share, whatever left in the company, that belongs to the common shares. That's why the common shares, we say that they have residual ownership because they're the last who's going to get anything. Let's see in this case again issuing the shares, only issuing the shares we're talking here. Preferred shares are accounted for the same as the common shares. Say for example, let's say issue 1,000 shares for $100 per shares, which give the shareholders rights to the dividend of $10 per share. We're going to receive $100,000 cash, $1,500, and we're going to issue our preferred shares for $100,000. 1,000 preferred shares, $500 per share. Now on the balance sheet, we're going to increase the contributed capital. And the balance sheet now is going to have under contributed capital, we're going to have common shares and preferred shares. Is it possible to have a different type of shares? Yes, we have. We may have a convertible preferred shares. If we have the convertible preferred shares and the shareholders of those shares decide to convert them into the common shares, then what we're going to do, we're going to just move from the preferred shares into the common shares. So in this case, we have to debit the preferred shares to reduce the preferred shares and credit the common shares to increase the common shares. There will be no actual transaction of cash or anything like that. So it will be one equity goes down, preferred shares, one equity goes up, common shares. And we converted preferred shares into the common shares. And on the statement of the owner's equity, what we're going to see, again, we're going to see contributed capital, retained earnings. Contributed capital. Now, in the section of the contributed capital, first going to come preferred shares. Why? Because they're higher than the common shares. Whatever is higher, whatever is more liquid, it's going to go up. So preferred shares will be first. Second will be common shares, total contributed capital, and then we have retained earnings and total shareholders' equity. And that's how we're going to structure our statement of that will be balance the shareholders' equity on the balance sheet section. That's not actually a statement of the shareholders' equity because it doesn't have the beginning balance, ending balance. Now, what's interesting here, which is the numbers. Again, we have the contributed capital, we have the retained earnings. Inside preferred shares, we have preferred shares. The first number after the preferred shares give you the fixed dividend that has to be paid to the preferred shares. Second one is the number of authorized shares. So during the life of the company, this company can issue 10,000 preferred shares. Currently, the company issued and sold 900 shares. That's why 900 are issued and outstanding. For the common shares, same thing. They're not getting fixed dividends, so there's no dividend here. But we have 100,000. The company has 100,000 shares authorized. That means over the life of the company, they can issue 100,000 shares. Currently, they issue 25,700 shares, which are also outstanding. That's how we should interpret those numbers. So, this is the consideration. Should I issue shares and increase the equity, or should I borrow money? Now, what's the cost? First, if you issue the equity, or if you issue common shares, for example. The common shares, interesting thing is, the company has no obligation to pay dividend. They're going to pay dividend only and only when they declare dividend. So the company in this case may declare dividend. Same with the preferred shares. However, if you borrow the money, you have to pay the interest. There is no options not to pay the interest. However, if you issue shares, common shares may have a voting rights. So basically, you may lose the control of the company. With the preferred shares and the debt, there's no such problem. Repayment. Whatever money you get from the shareholders, you don't have to pay them back. You have no obligation to pay the money back. But if you borrow the money, you have to pay the money back. For the tax purpose, dividend is not tax, where the interest is tax deductible. Ethical issue here is value of the shares. An issuing company wants to record a large amount of the non-cash received. Those will be to inflate the equity by having less cash or less assets. For example, when I open the company, I may invest. I don't have cash, so I invest in my laptop. But I'm assigning $100,000 to my laptop. Now I have assets for $100,000, and my equity in the company is $100,000. How is this ethical? No, obviously it's not. Is it going to have a positive effect on my ratio? Absolutely. Now, as you can see in this transaction here, we have this huge amount expense for issuing the shares, $7,238,000. That's for issuing the shares. What we're going to do, those are called organization cost. Cost for the legal fee, incorporating, promoters, anything for the opening the company, which is called cost of the organization of the corporation. How are we going to treat those one? We have two ways. Under the accounting style for the private enterprises or for the private companies, they have to show these expenses as all the cost. They have to show it as a intangible asset. If you're a public company, you can directly expense this cost. So, how are we going to deal with the organizational cost? Organizational cost, it can be incorporation fee. In the accounting standard for the private enterprises, we're going to accumulate it with the account called organizational cost, and we're going to amortize them, where in the public corporation, we can directly expense them. Now, something extra for you, for the organization cost, accounting standard for the private enterprises allow you to amortize those costs in the first year of operation. So you don't have to keep it. For tax purposes, you can directly expense it, but you're going to see this when you're taking the taxes. Now, question for you, because we're getting a little bit deeper, and we're just probably halfway through the chapter. Now let's see how we're going to deal with the cash dividend. Remember, those shareholders, they have a family to feed, so they need cash. In order they to feed their family, we have to give them a cash dividend. For the cash dividend, first thing first, in order to declare dividend, the company or corporation needs to have a retained earnings. That's the first requirement. Second requirement, for the cash dividend, the company has to have cash. So the board of directors, they have to declare the dividend before it's paid. And they're going to look for two things. Do we have enough retained earnings? Because if you don't have the retained earnings, there's no dividend. And second, if we're giving the cash, do we have enough cash? Because we don't want to sacrifice our working capital by giving that cash to our shareholders as a cash dividend. Now, once the dividend is declared, that is the point when the dividend becomes a liability for the corporation. There are three important dates on the cash dividend. Date of the declaration is when the dividend becomes a liability. Date of the record and distribution date. Now let's see. First one, declaration date again is the where the dividend become a dividend payable or become a liability. That's why we're making the journal entry to record the liability and reduce the retained earnings. Second date, the date of record is the date when on that date, whoever has the shares, he's going to receive the dividend. So we're putting that. So basically, the dividend declaration of the dividend is going to look like this. Today, the board of directors, today, December 1st, the board of directors decide to declare the dividend to the shareholders on the record of December 15th, which dividend is going to be distributed on December 25th. So now we have the three dates. Date of declaration, today, December 1st, become a liability. Who's going to receive the dividend? Whoever has the shares on December 15th. When they're going to receive the dividend? On December 25th. That's how basically the statement is. Example again is here will be a 5,000 cash dividend is declared on October 3rd to the shareholders of record on October 31st. And the dividend is going to be paid on November 15th. So on the declaration date, the company is going to reduce the retained earnings, debit retained earnings, and they're going to credit dividend payable, or basically increasing the liability. That's on the declaration date. Then we have a date of record. On October 31st, there will be nothing. There's no journal entry on the date of record. On the distribution date, since we have to give the shareholders cash, then we're going to reduce the dividend liability, debit dividend payable, and we're going to distribute the cash, and we're going to reduce the cash in the corporation, credit cash. Those are the journal entries for the cash dividend. Now, again, declaration paying the dividend when we have the preferred share and common shares. Now, let's assume this company has 1,000 shares. Property has 1,000 shares of $5 preferred share. $5 means every share should receive $5 dividend, fixed dividend, outstanding, plus common shares. Now, if the company declare dividend of $5,000, who's going to get them? Well, preferred shares, since they're getting $5 per share, they're going to get $5,000. But the entire dividend is for $5,000. Then the common share is going to get nothing. So only preferred shares get their dividend, common shares get nothing. The second scenario, let's see the second scenario. Now the company declared $30,000 dividend. Well, in that case, preferred shares still going to get their $5 per share, in total $5,000. But in this case, there's something left. How much left? 25,000. Who's going to get 25,000? Common shares. And the common share is going to get $25,000. Now, the interesting thing with the common preferred shares is that they might be cumulative. What means cumulative is? Cumulative is if the dividend was not declared of any of the previous years, that dividend is not lost for the preferred shares. They're gonna get it when the company or the corporation declare dividend. So that's why those dividends are called in arrears. This is the term, dividend in arrears. Both should be highlighted, even in should be highlighted here. Anytime when you see this term in arrears, means that we're dealing with preferred shares, which are cumulative, and they have to receive dividend from the previous years. When the dividend is declared, what we're going to do is we're going to pay the dividend first we're going to pay the dividend on the preferred share for any of the previous years. Second, we're going to pay the preferred shares the dividend for the current year. Third, if there's anything left, common shares going to get it. Now the common shares, they can never be cumulative. Only preferred shares are cumulative. Now let's see how this is going to work. Now assume that the company again has 1,000 preferred shares which receive $5 per share. The company didn't declare any dividend in the 2023 year. In 2024, they declared 4,000 dividend. Now, who's going to get what? First, we're going to give the preferred shares all the dividend from the previous years which they haven't received. So we're going to check, is there any years from before which preferred shares did not receive the dividend? Yes, there is. In 2023, the dividend was not declared to preferred shares. So preferred shares going to get the dividend for 2023. Now we're 2024. Then second, preferred shares going to get the dividend for the current year. Another $5,000 for the preferred shares. Is there anything left? Well, from out of 40, we already paid 10,000 to the preferred shares for the previous and current year. So 30,000 left. Who's going to get those one? Common shares. So our journal entry will be on the declaration date again. Will be reduced the retained earnings with $40,000. Dividend payable preferred shares have 10,000. Dividend payable common shares 30,000. Now, which one is liability, which one is not? Liability is created on the date of declaration. Then that brings the question, what if we haven't paid preferred shares dividend from the previous years? Is that liability for us? Legally, it's not. Technically, stays as a, how can I say, commitment to pay that dividend. And it has to be disclosed in the notes of the statements. But legally, it's not liability. Not until the dividend is declared. Once the dividend is declared, that dividend in arrears become a liability. For the non-cumulative preferred shares, since they're not cumulative, we don't have to do anything. So basically, when we declare dividend, we don't have to pay any dividend which hasn't been paid to the preferred shares for the previous year. Let's see how we're going to use the different shares value for in the decision making. Now, for the business community or the investors or people who's doing the shares, they're using two terms. One is the market value, and the other one is the book value. What's the market value? Market value is the value that the shares currently worth on the secondary market, which is the stock market. So once you sell the shares, whatever price you're getting, then they're going to the secondary market. Why? Because you already sold that first time. Second time, now they're moving from one hands to another hands. What's the value of those shares? The market value, whatever market is willing to pay. The book value is simply the value that's staying on the equity account under the common shares divided by the number of shares. That's how we're getting the book value. Again, market value is determined by the net income. So what drives the market value? So many things. It can be net income. If the company generating income, that's going to increase the market value. Why? Because the investors now say, okay, company generating income. That means there will be more retained earnings. If there's retained earnings, we may have to get the dividend. Second one, financial positions. This company, they're increasing their value as a corporation. Future prospects. Well, this company specifically, it's going to invest in the next space shuttle, which is going to bring us to Mars, where in Mars we're going to find this lithium, which is super valuable, and the company is going to have access to this material, which is very, very highly expensive. Obviously, the market share of the corporation is going to start going up. Or general economic conditions. The company just recently hired, or no, sorry. Oh yeah, let's go with this. Company recently hired Elon Musk as a consultant to so he can go over the whole company operation and find a way to save the money. That may boost the company shares. In almost all the cases, shareholders are more concerned about the market value rather than the book value. Why? Because the market value is the one that they can sell the share or buy the share. What's the book value? How can we get the book value? Now, watch this. The book value is the total shareholders' equity minus preferred equity divided by the number of the common shares outstanding. So we're going to get the total shareholders' equity as a number. We're going to deduct what belongs to the preferred shares, whatever left, divided by the number of common shares, to give us the book value of the common shares. Now the question is, what's the book value of the preferred share then? The preferred equity. But what's the preferred equity? Preferred equity is liquidation value of the preferred shares, or if you want to get rid of the preferred shares, how much we have to pay now. Plus, do we own any dividend in arrears on the cumulative preferred shares? We're going to get just two numbers. That's going to give us preferred equity. Divided by the number of the preferred shares outstanding, it's going to give us the value of the preferred shares. Make sense? So basically here, the preferred equity, as you can see it here, preferred equity, keep in mind, is the liquidation value plus dividend in arrears. So that preferred equity should be substituted with the liquidation value plus dividend in arrears if you have to calculate. Let's see here the example, the book value. So preferred shares have a $7 dividend per share, $90 liquidation value. Let's make it bigger. Preferred share pays $7 dividend, $90 liquidation value. Those are cumulative. 5,000 shares are authorized, so we're not working with the 5,000. 5,000 is just ignore it. 1,000 are issued and outstanding, so we're playing with the $1,000, 1,000 shares. Common shares are 20,000 authorized, ignore that value. 5,000 are issued and outstanding. Now, the 3 years preferred shares are in arrears. That means preferred shares haven't received dividend for 3 years back. So, the preferred shareholders must calculate the common shares. So, if we want to, the preferred share equity must be calculated before the common shares is calculated. That's obvious. So, how are we going to get this? We're going to get the liquidation value. We already saw that $90 we have to pay for the liquidation. We have to pay $90 per share. We have only 1,000 outstanding. That's going to give us 90,000. They get preferred share getting $7 dividend over 1,000 shares. That's 7,000. But we haven't paid for 3 years. 3 years. Plus, we're going to include the current year, because we own the dividend for the current year. And we're going to come up with the value. Once we do this, we're going to end up with the book value per preferred shares to be $118. Now the common shares. Once we get the total equity, which is $340,000, minus preferred shares, don't forget the preferred shares equity is equal to liquidation value plus the dividend in arrears, or $118,000 minus that divided by number of shares outstanding 5,000 is going to give you the book value per common shares. And that's how we get those numbers. Can we use the book value for decision making? Well, that may be a factor to determine the price to pay for the closely held company. But the thing is, if the market value is below the book value, that means only one thing: you should buy shares of that company because the company is undervalued. Or the company may experience difficulties. But you have to be careful when you invest in, correct? Now we're going to go talk about return on asset and return on equity, but let's leave those one for the next time, if that's okay with you, because we have only 4 slides to cover on the return on assets and return on equity.
Yes, we can
And-
finish, bro.
Do you want me to finish it?
Oh, I mean, I don't mind, but I don't know my classmates.
Do you guys want me to finish this, or you want me to leave it for the next time?
Leave it for the next time, bro.
Leave it for the next time. Okay, let's leave it for the next